discussing about the monetary policy, which is a part of the HL economics course. So within this, let me just initiate my lectures then. So in the monetary policy, we'll be discussing about basically these four types of tools which is available at the hand of the central bank to change the money supply in the economy. So we know that in basic macroeconomic stabilization policies that we study in the course is about the fiscal policy, and another is the monetary policy. So in the monetary policy will be, these are the tools which are available at the hand of the central bank with which it can influence, change the money supply in the economy. So why, and then the basic question that comes to our mind, that why the central bank changes the money supply in the economy. See, our economy, the economy can go through the various cycles. It can have a high unemployment in the economy, right? The economy can face a problem of high unemployment. It can face a problem of high inflation, and it can also face a problem of, let's say, deflation, right? So these are the macroeconomic problems which an economy can face. So what central bank can do, while through the instruments that are available at its disposal, what central bank can do, that is what we are going to understand. So in that, we will be understanding how change in the open market operation, how change in the central bank minimum lending rate, and the minimum reserve requirement and quantitative easing with which the central bank can change the money supply into the economy. And once the money supply is changed in the economy, it has an impact on the consumption and the investment patterns in the economy, and that in turn has an impact on the aggregate demand, and hence the output and inflation. These variables get impacted in the economy. So now let's begin with the open market operations. So in the open market operations, we discuss about something called as basically these open market operations are conducted by the central bank so it can involve itself into the two types of operation. One is the open market sale of the government securities, and another is the open market purchase of the government securities. So basically, we need to understand how selling and the buying of the government securities by the central bank can have an impact on the money supply. So let's suppose we have this as a central bank, and here we have, let's say, the institutions which buy the government securities. So when the central bank is selling the security, right? So it is just like, let's suppose it is selling the government bond to the people. So in exchange, what it would be getting back is the money, right? So it is selling the government, let's say, government security. So in exchange, it would be taking money. So in a sense, the money supply gets there is a reduction in the money supply in the economy. There is less currency available now in the hand of the consumers and the investors. So there will be a decrease in the money supply. So basically, when the central bank involves itself into the open market sale, it results into the reduction in the money supply. And generally, the central bank tries to decrease the money supply if the economy is facing a high inflation, or the economy is going through a very high there is a boom there is a boom period which is getting created into the economy. Okay, so then we can discuss about something called as the open market purchase. So here the process is just the reverse. Now the central bank, let's suppose this is our central bank, and this is the institutions which buys through which the central bank buys and sell the government securities. So what the central bank can do is that now the central bank is buying back. So the central bank is buying back the government securities. So when it is buying back the government securities, in exchange, it will be giving the money, right? So as a result, the money at the hand of the money in the hands of the consumers and the investors eventually will increase, and as a result, there will be an increase in the money supply. And what is the purpose, and which economic situations the central bank go for increase in the money supply? Let's suppose the economy is facing through the lower unemployment, right? So the central bank wants that there should be it should take some steps so that the output can increase in the economy, and then hence when there is more and more of production into the economy, that would eventually lead to the creation of more employment, right? So the open market sale is often called as the contractionary monetary policy, for the reason because it reduces the money supply. Okay. And open market purchase is called as the expansionary monetary policy, because it leads to because it injects the money supply into the economy, that is because it increases the money supply into the economy. So now we have understood one of the tools which is available at the hand of the central bank, through which it can change the money supply in the economy. And different so whether the central bank will go for increase in the money supply, or it will go for decrease in this money supply, it will depend upon the prevailing economic situation in the economy. So if the economy is facing a high inflation, so that means the central bank will have to go for the contractionary monetary policy. That is, if it wants to use the open market sale as an instrument to change the money supply, then it would go for open market sale. So the next thing that we discuss is something called as adjusting the central bank lending to the bank. Okay. So in many countries, it is observed that the central bank provides extra money to the banks. Um, if the banks obtain less money in this way, it will have to cut back on the lending, right? Okay. So whether or not bank choose to obtain an extra money from the central bank, it depends upon two things. One is the rate of interest that is charged by the central bank, and that is often called as different in different countries, it is called by different name: discount rate, repo rate, and the lending rate. And the second important factor in deciding about how much the commercial banking system which will be borrowing from, let's say, the central bank, will depend also upon its willingness to lend. Okay. So basically, this is one of the tools with which the banks can borrow money from the central bank, because the central bank is the bank of all banks. So if there is any bank which is facing some situation of liquidity crisis, so it can borrow from the central bank as well. So in that scenario, by central bank, by regulating the amount of borrowing which can be done by the commercial banking system, it can have an impact on the money supply. Okay. So if suppose the higher this rate is relative to the market rate, so let's suppose if the banks can borrow in the market at 6%, but the banks can borrow from the central bank as, let's say, 6.5%, right? So they will be less willing, since they will be less willing, the bank will be to borrow from the central bank, and hence that would lower the monetary base, and that would again lower down the money supply in the economy, right? So this is the second tool that we understand how central bank. One we had understood as the open market operation, buying and selling, and then we have understood how central bank can regulate the lending to the banks, through which is called as the repo rate, and or the lending rate, or the discount rate. Okay, so in some countries, central banks operate two rates. One is called as the main repo rate. Basically, we understand two types of rates which is often discussed. One is the repo rate, and another is called as the reverse repo rate. Okay, so and these both the rates are controlled by the central bank. So the repo rate refers to the rate at which this is the rate at which commercial banks borrow from central bank, and this reverse repo rate is the rate at which central bank borrow from commercial banking system. Okay, so this main repo rate is also called as the refinancing rate, and on the set of the amount money that the central bank wants to be made available. Okay, then a higher rate, that is also the lending, since the central bank is the bank of all banks. It acts as a last resort to the lending if when the bank is facing some liquidity crisis. So if there is some emergency need of the funds by the commercial bank from the central bank, that is offered at a higher rate, which is called as the penal rate, and the another name that is given to it is called as the marginal lending facility rate. Okay, so let's move on to next important tool which is available at the hand of the central bank is the minimum reserve ratio. So before understanding this idea, we need to understand one important concept in terms of what is the amount of money supply that gets created on the basis of the base money in the economy. So this formula is basically 1 upon minimum reserve ratio. So I'll be explaining what this minimum reserve ratio is. So, and the money multiplier is nothing but 1 upon minimum reserve ratio. Okay. So it's simple as saying, let's suppose there is 100 pound deposit with the bank. So with this 100 pound deposits, how much money it can how much money it can create is being decided by this money multiplier. So the central bank can ask the banking system that they have to keep certain proportion of these deposits as reserve ratio, right? And this is done in order to meet the withdrawal if there is a sudden withdrawal demand from the public. So some people who have deposited their money into the banking system, they would be needing that money for some emergency fund, for emergency needs, let's say, or their requirements. So there will be a certain proportion of the money which would be withdrawn at the same time. So in order to meet that requirement, the central bank asks the banking system that they should maintain certain proportion of their deposits in the form of reserves. Okay, and that is called as the minimum reserve ratio. And by changing this minimum reserve ratio, basically the central bank can change the amount of money supply into the economy. Okay, so we will be understanding this with a very like one example we will take, and we'll understand that how changing the minimum reserve ratio can have an impact on the money supply in the economy. So let's consider this as an example. So let's suppose the central bank initially had decided about 10% reserve ratio. So, and the reserve asset with the bank was 10 billion. So with this 10 billion, so if the reserve ratio is 10%, so we can know that the multiplier is given by 1 upon this 10%, that is 0.10. So the multiplier is 10, right? So the total amount of money supply, that is the total amount of money supply, would be this multiplier times the reserve asset, which is 10. So that is total is 100, right? So if total is 100 and the reserve is 10 billion, so the advances becomes equal to the difference of the two, and the total deposits is 100 billion. Now suppose the central bank has decided to increase the reserve ratio. Once it increases the reserve ratio, then the multiplier, the new multiplier, let's say, it becomes 1 upon 0.20. So which is basically 5. So the new multiplier is 5, and with the same amount of assets which the bank had previously, now it can only create a money, the total money that it can create is 5 into this 10, which is 50, right? So we can clearly see that with the increase in the reserve ratio, from minimum reserve ratio from 10 to 20%, the central bank has been able to reduce the total money supply, it has been able to reduce the money supply. Okay, so the three tools, now we have understood how the central bank can change the money supply in the economy using the open market operation, minimum open market operation, then the rate at which the central bank lend to the banking system, and then minimum reserve ratio. So the last tool which is available at the hand of the central bank is called as the quantitative easing. So we understand that the central bank, if it wants to stimulate the economy, if it wants to go for expansion of the output, it generally goes for increase in the money supply. Increase in the money supply, which lowers down the interest rate. With the lowering down of the interest rate, the investment increases. With investment increases, then buy increases, right? But there is an extent to which we can keep on increasing the money supply, right? So the interest rate can keep on decreasing, but there is a zero lower bound, right? So we consider that there is something called as zero lower bound. That is, interest rate cannot go below zero. The central bank cannot keep on increasing the money supply to an extent that the interest rate goes to the zero. Although the empirical data suggests that some of the countries are charging negative interest rate, which means that they do not want people to keep the money in the form of the deposits into the banking system. They basically want them to invest that money. So if they invest that money, that would lead to the creation of more investment will lead to the creation of more output and the investment demand, right? So this situation is called, when the people are not willing to invest or consume, then that situation is called as the situation of liquidity trap. So when the central banks face such a situation of the zero lower bound and the liquidity trap, then the central bank goes for the quantitative easing. So this quantitative easing is like this is an additional tool. We make a distinction between the traditional tools and the conventional tools and the unconventional tools. So the three tools that we have read before, they are called as the conventional tools of monetary policy, and basically this tool is often given a word which is called as unconventional ways of increasing or changing the money supply into the economy. So in this form of monetary policy, injects the money supply directly into the economy by central banks purchasing the corporate bonds. Now they are increasing, they are basically increasing the assets which can be purchased and sold in the exchange of money. Earlier, when we were doing the open market operations, there it was more involved in terms of government securities. Now they are bringing in more form of, even the corporate bonds can be exchange in for the money. That is, it can be used for regulating, changing the money supply in the economy. So the institutions selling these bonds to the government, such as the commercial bank and the insurance companies, they have new money in their account, and the bank sees an increase in the liquidity, right? And once the bank sees an increase in the liquidity, that leads to an increase in the money supply in the economy. Okay, and higher money supply is needed in order to stimulate the economic activity. Okay, and as we mentioned, if the economy is facing from the period of situation of deflation, see, we understand that if the economy is facing from inflation, then the people are the people are more worried, that is, all the prices are going up. But similarly, the situation of deflation can also be a very problematic scenario for an economy. So the reason is that when there is a deflation, then the producers might not be having that incentive to produce. Basically, they are not getting the prices for their they are not getting the prices for the product that they are selling, so as to cover their cost also, right? So in both inflation, high inflation, and also as deflation can be a deflation is also a problematic scenario for an economy. So when the economy is facing from the deflation, the central bank can use the quantitative easing method in order to increase the money supply and bringing out the economy from the situation of deflation. So these are the four tools. This is related to the quantitative easing itself, like how the central bank creates money. The central bank then buys from the financial institutions, that is the corporate bonds. Then this reduces the interest rate. This leads to increase in the business from people borrowing more money, and eventually that leads to the this we have already discussed. This eventually will lead to the increase in the output, and it will boost the economy. Okay, so this is a quick brief discussion about the monetary policy, and then the tools which are available at the hand of the central bank, with which we have discussed open market operation, change in the central bank, minimum lending rate, and the minimum reserve requirement, and quantitative easing. So we will continue with the discussion of the other topics in the later classes. Hope you liked the lesson and see you next. Thank you.